guys, welcome back to another video. I hope you had a wonderful weekend and a good start to your week. So as you guys know, I try not to make predictions anymore about what will happen in a month, 2 months, a quarter, even longer, right? And the reason I don't do it is because, to be quite frank, the freight market is unpredictable at the moment. However, I do want to talk about peak season today and use current data in order to theorize whether peak season of 2023 will provide carriers with the relief, whether it be temporary or permanent, in the coming weeks and months. Now, if you're new here, welcome. I teach about the trucking industry with a heavy focus on the spot market as well as freight market analysis as we try to make sense of this craziness we find ourselves in the trucking industry. So if this is a topic that interests you, feel free to subscribe and join an amazing community. So peak season is something that carriers, owner-operators, drivers, and dispatchers really look forward to because historically speaking, this is the time where we on the trucking side actually tend to make more money than throughout the rest of the year. So let's talk about it and see what it means for 2023. Ready? Let's go. All right, I'm making myself comfortable here because this is going to be a lengthy conversation. So I know that most of you guys know what peak season is, but because this is an educational channel, I have to take into consideration that some people who either don't follow seasonality or maybe are completely brand new to the industry, they might not know what it is. So let's talk about what peak season actually is. Now, peak season occurs from mid-August through the end of November. Although some will argue that it's actually until the end of October, and then from the beginning of November to December is technically holiday season. It just depends on who you ask. Usually this is a time where there is increased demand over a variety of markets and sectors because consumers have been pre-programmed to start shopping around this time. And they start shopping for back to school, then those holidays, right, in the holiday season, grabbing those fantastic deals that we all get on Black Friday and Cyber Monday and so on. Now, retailers react to this demand, of course, and they start usually placing more orders of the inventory that they believe their customers will want to buy. At the same time, they start moving the existing inventory using sales and discounts, for example, Black Friday or Cyber Monday, or just random sales that happen on a monthly basis or whatnot. Basically, retailers are trying to make space for new inventory and grab that opportunity of increased consumer demand to hopefully make more money. Now, of course, there is a chain reaction that happens when consumer demand increases. So let me show you. This is an image I found from Dr. Google. So let's take a look. Now, as consumer demand starts going up, retailers start ordering more things because they understand that, hey, consumers are interested in buying things. So that means that we have to have more inventory to make more money. So they start placing more orders with the distribution center. Now, the distribution center, seeing this demand and making sure that they don't run out of inventory, they start placing more orders with the manufacturer, right? So this goes up. Now, oops, what kind of error is that? Now, manufacturers, as they see more demand from distributors, they start placing more orders with suppliers, and suppliers start placing more orders with the raw materials provider. So what does this mean? Well, it means that a shipping frenzy starts, and the best part is we are involved in all of these processes, right? Because we're the ones transporting the raw materials to the suppliers, these supplies to the manufacturer, the manufactured goods to the distribution center, the finished goods to the retail locations. We are part of all of this. So to put it plainly, peak season is when volumes start usually increasing. Now, we all know that as volumes increase, provided that capacity stays the same or even decreases a little bit, rates will start going up. And this is why peak season is something carriers wait for, because those volumes usually translate to higher rates for loads. All right, so now that we understand peak season, let's chat about what can actually have an effect this year, whether positive or negative. And we're going to start with the US consumer, because as we already saw, peak season really revolves around or stems from this whole idea of whether the US consumer is ready to buy more stuff. Now, as we already know, over the past year and a half, the Federal Reserve has made 11 aggressive hikes in rates to curb consumer spending, which is insane to me, but this is the truth. Yes, consumers have been extremely resilient when it comes to purchasing things over the past 18 months, but the problem is, and this is a question that all of you will probably have, why can't we feel it? If consumer spending is still there, why are we not feeling it in our industry? Well, because consumer spending has been focused predominantly on the service sector, not the products and goods that we actually transport. But the reality is, those interest hikes are starting to affect the consumer's spending behavior, as it should. And then we, of course, have to remember October. Following a 3-year pause, October 2023 is when those student loan repayments will be due. Now, according to an article by CNBC, and I quote, "It is estimated around 40 million Americans have debt from their education, totaling nearly $1.8 trillion. And the typical monthly bill is $350 per month." Why is this important for us? Well, because now we know that around 40 million Americans will have $350 less per month to spend on other things they want to buy. And now if you pair it with the interest rates, you understand that the US consumer's buying power is even weaker. Now, I wish I could say this was just a theory. I promised that we would be theorizing, but unfortunately it is not. Around August 10th, the National Retail Federation released an article that was titled, "NRF Economist Says Growth in Consumer Spending is Slowing." Now, according to Jack Kleinhans, I might be mispronouncing his name, I'm sorry if you're watching, the chief economist, he said, consumers are still spending, but are under financial pressure and have been adjusting how much they buy while also shifting from goods to services. While job and wage gains have counterbalanced inflation, the stockpile of savings accumulated during the pandemic is dwindling and is no longer providing as much spending power as previously available. Now let's think about it for a second. Although this article does not necessarily say that consumers are spending less, no, it just says that consumers are still spending more. But the rate at which that spending is growing is slowing down. Who will take notice of such an article? Retailers, of course. What retailers don't want is to order more inventory than they will move, right? Because they have been burned month over month for the past minimum 18 months. So they are scared. However, and this goes back to the reason why I no longer make predictions, right? This NRF article was released about 5 days before the Census Bureau released actual data on what the retail sales looked like in July, which everyone was saying would be horrific. July would be horrific. Let's go to the board. So surprisingly, July, right here, here's 23, here's July, it increased. These are the retail sales month over month. Those increased by 0.7% from June. One thing to note is that this figure is adjusted for season variation, the holidays, and the trading day differences. However, it is not adjusted for price changes. So my point to you is, and I'm sure you guys will agree with me here, question everything, question all the data. This is a really good habit to have. Now, as I mentioned before, inventory is another thing we have to look at because it's an integral part of trying to theorize about peak season of 2023. If retailers and businesses are experiencing inventory bloat because they cannot move the existing inventory, well, guess what? That means that they're not going to be placing as many orders as we would hope because they're more concerned with moving the existing inventory that is costing them money. And if they're not placing many orders, that means that those volumes are not increasing by much, right? So inventory is something we really have to pay attention to. So let's take a look. So here's a chart from the Census Bureau, and we are looking at both inventory levels for different types of businesses as well as the inventory to sales ratio. We are going to be looking at raw unadjusted data. Let's take a look. Now, one thing to remember is that this unfortunately only goes until June of 2023, but it gives us an idea. So the red highlighted parts, these are retailers and businesses whose inventories went up from May to June, right? And this is in millions of dollars. So whose inventory increased? Motor vehicle and parts dealers, food and beverage stores, and general merchandise stores. Now, furniture, electronics, appliances, building materials, gardening equipment, supplies, clothing, accessories, and department stores actually saw a decrease in their inventory month over month. But what about the inventory to sales ratio right here? And just to remind you, what we want to see is the ratio going down. The lower the inventory to sales ratio is, the better, because that means that inventory is actually moving. So as you can see, everything is red except for furniture, home furniture, electronics, and appliance stores that saw a decrease in the inventory to sales ratio month over month. So that means that all the other retailers, the red ones, which includes the motor vehicle, building materials, food and beverage, clothing and clothing accessories, general merch, and department stores, they're having a harder time in June than in May moving their inventory. Now, according to Reuters, and I'm going to read this, with pandemic-related shipping problems in the rear-view mirror, major U.S. retailers are no longer buying more than they think they'll need to cover the goods that arrive late. Mega retailers are returning to the just-in-time inventory strategies, killing the just-in-case promise of the pandemic supply chain snarl. So what does that mean for us? Well, judging by the inventory levels, the inventory to sales ratios, and the fact that retailers are moving away from this just-in-case mentality and they're just ordering enough to get by, well, we can theorize that unfortunately we're not going to be experiencing a shipping frenzy this year. On a positive note though, because we do want to see the positive in everything, is when it comes time to start shopping, you probably will see some nice discounts on Black Friday, Cyber Monday. Maybe these discounts will be a little bit more steep than in prior years because retailers need to move their existing crap. Now, of course, we have to touch on capacity, right? Because volumes are not the only thing that can drive rates up. It's also a lack of capacity. Even if volume goes down, if capacity decreases in huge numbers, rates will still go up, right? This is supply and demand. Now, every single week on Friday, we take a look at capacity and we see week over week that the net change in carrier population is negative, which means that there are more carriers leaving than entering this industry. But unfortunately, the reality is that not enough carriers are leaving at the moment to actually have a huge influence on those rates. We also can't forget those carriers who have paid off their trucks and trailers and are simply parking their equipment and waiting for better times. Now, I don't have an answer to this, but rather a question to the universe or a theory. Peak season has historically been the time where carriers make money, right? So the question is this: how many existing carriers who park their trucks will come back into the game? And how many new carriers will come into the game hoping to catch those high-paying loads? And considering the fact that volumes might not increase as much as we all hope, what will this increase in capacity do, and how will it dilute the load to truck ratio and therefore the rates? Again, these are just questions. I am not saying this is going to happen. These are theories. But I'd love to hear your thoughts on this. Now, there are also a ton of predictions about peak season, and I'm going to read you several quotes from several different people. First, we have Adam Engel, the SVP of ITS Logistics. I'm sure you guys will love me for this one. And he says, Peak season this year is going to be muted for import drayage due to historically high inventory levels at all shippers in almost every segment in the U.S. economy. Consumer spending on discretionary goods is the largest contributing factor to the size of peak season we will experience for domestic truckload demand and inventory levels. With the health of the consumer continuing to be very resilient, we do expect that there will be more of a robust domestic truckload peak season than the traditional import peak season. So for the trucking market, the domestic trucking market, he has a more positive view, which is nice. Now let's read the next one. And this one is from the chief executive of, and I'm going to butcher this, so correct me, Quen and Nagel International. I have no idea how to pronounce this, but he says, there is no peak season to be expected in 2023. There are no signals neither on air or sea, at least not for the time being. So we have to be very cautious of that. And then we have the EVP of JB Hunt, Darren Field, who said, I don't have any customers really predicting a significant peak season, so we're not hearing about needs for capacity in an elevated manner for the holiday shopping season. And finally, we have the Werner Enterprises CEO, Derek Leathers, and he said that a muted peak season is likely to be the outcome for 2023. So there it is, guys. Now, what can we deduce from this? Well, considering the downward pressure on consumers and their buying power, considering the inventory levels and inventory to sales ratios, we can theorize that there is not going to be a shipping frenzy like we are hoping for. It's going to be more muted. Does it mean that it's going to be completely flat? Personally, I don't think so. I think we are going to see a bump in volumes and rates at certain points, but not the types of rate increases that we are all hoping to see, and definitely not enough to kind of relieve us from the crap that we have been dealing with for the past 18 months. I would love to hear your thoughts on peak season of 2023 because, as I said before, you have to question everything, right? An economist who is the top in his field might be wrong, data might be skewed, and so on. So again, I would love to hear what you guys have to say about peak season, whether you think there will be an increase in volume, whether you think that capacity will all of a sudden increase, hoping to grab those opportunities, not realizing that there is potential for a very muted peak season, just like we saw with the produce season. Anyway, guys, that's all I have on this topic. I hope that this video gave you some perspective. Maybe it gave you some ideas of how to adjust your operations a little bit. Now, I wish I could tell you guys that we're about to turn the corner and we're about to start making some serious cash, but unfortunately, it looks like a little bit more patience is in order at this point. Wishing you all a fantastic rest of your week. Keep your chins up, and remember, it cannot rain forever. I'll see you guys in the next video.